for more on this extraordinary commodities pullback, David Stroud is on the phone from Auburn, Alabama. David is CEO of TS Capital. It's a hedge fund that focuses on commodities. David, is the rout over, or is there more to come?
There's more to come. The Who, another tricky day, another tricky day for you. This is no social crisis. If you remember that song from The Who, that's the mantra for Wall Street. I think yesterday was just the beginning. If you watched the markets toward the end of the day, there were no buyers coming in. It was all sellers.
No seller. I'm sorry, no buyers. So what does that mean? How much further do you think commodities markets could pull back?
Well, typically commodity markets, if you look at, let's compare it to the stock market, to the S&P 500, the average commodity of the top 25 commodities traded is about 4 times more volatile than the stock market. So when it pulls back, it doesn't pull back 7 or 10%. It pulls back more like 30, 40, and 50%. I wouldn't be surprised, and I actually would be satisfied if we saw a 25 to 30% pullback in the commodity markets.
Okay, so I have to assume that if you think we could see another 25 to 30% drop, you are short. Are you short across the board, or are you short specific commodities and maybe a little more reluctant with some others?
Great question. Very, in the short term, we are short across the board on every commodity. If you look at the top 25 liquid commodities that are traded on futures exchanges, we're short each one of those. Now, that's just short term. As we were talking about in the pre-interview, we just got back from China. If you look at the growth going on in China, you know that that country is going to have to continue to consume commodities. So in the short term, we're extremely bearish and short across the board. Long term, we see this as an incredible opportunity.
Okay, the timing is going to be extraordinarily key. Do you have any, clearly you have to wait to see how trading plays out and how some of these commodities move before you would be prepared to go back in with some long positions. Yeah. But what kind of time horizon do you think we're talking about?
You know, it's really impossible to say. What happens? You see a furious sell-off like yesterday, and what happened there? You know, we've talked about silver a lot in the past 2 days, but cotton did the same thing 2 months ago. Margin requirements were increased. Cotton prices substantially went down. They go from $2.10 a pound down to $1.50 a pound. Same thing silver did yesterday. I would anticipate over the next 3 to 6 months that you're going to see this decline, 25, 30% or more of a decline. And once everyone just gets sick of it, once everyone stops talking about commodities, that's probably about the time that we will re-enter and do so being long.
Is it fair to say that the raising of margin requirements was just the catalyst, that This market was primed for a drop and was waiting for something to prod it along?
We were waiting on it, and look at it like this. Yes, silver margins went up to $22,000 yesterday, and I'll explain this a bit. And it jumped from $11,000 to $22,000. However, a year ago, the margins to purchase one contract of silver was approximately $4,000. In other words, with the same amount of money that you spend today on one silver futures contract, a year ago you could have bought 5.
So what does that tell us?
So that tells us that the exchanges and the people that trade in this community know that the trade was just getting dangerous. You know, silver prices February of this year were at about $25 an ounce, and they traded up as high as to just it almost touched 50. So 100% return in a period of 3 months. That's just asking to be corrected.
David, we know that all kinds of speculative money has been going into silver and gold. Yes. What about some of the other commodities? Is it harder to be quite so certain that the increases we've seen there, given some of the factors you mentioned, Chinese demand, for example, that it was just all speculation?
I think a lot of it was speculation. Speculation can exacerbate a market one way or the other. Fundamentals are definitely going to drive a market, but speculation, so in other words, if you put a price to it and you say corn, cotton, wheat, any of the other commodities, what happens is fundamental demand was driving those prices up, but the last 15 or 20% oftentimes is the result of speculators jumping in our market, and they buy all at one time. That's why prices slowly go up. When traders sell, they sell all at one time versus buying versus essentially dollar cost averaging. And what you saw yesterday was everyone getting out as soon as possible, asking no questions.
And we see more evidence of the pullback this morning. David, thank you for joining us and helping us to understand the commodities story. It seems like it's in a free fall. That was David Stroud. He's the CEO of TS Capital from Auburn, Alabama.